The Fed just wrapped up their two-day meeting, and their latest move is sending shockwaves through the markets. Now, could this be the signal that interest rates are on the verge of plummeting in 2025, or is this simply a pause before they get worse again? Now, let's break down what they said in their last two-day meeting and how this can affect you as a consumer. So the Federal Reserve just announced that they're keeping the federal funds rate at a range of 4.25% to 4.5%. There are no surprises here, guys. That's what it was expected. However, two rate cuts are still on the table at some point this year. But the Fed indicated that they expect to see slower growth and higher inflation this year. In fact, the Fed lowered their economic growth forecast, saying that GDP will rise at a 1.7% clip this year, which is down 0.4 percentage points from their projections in December. And they're also projecting inflation to grow this year, 2.8%, up from 2.5% as it predicted at the end of last year. But what really caught everyone's attention is that the Fed is slowing down its balance sheet reduction, and here's what that means. Starting in April, the Fed will reduce the monthly cap on Treasury runoff from $25 billion to just $5 billion, while keeping the monthly cap on mortgage-backed securities at $35 billion. And so basically, by slowing the pace of their balance sheet reduction, the Fed is signaling that they are worried about tightening the market way too quickly and potentially triggering a recession. And this is where it really gets interesting. Because the Fed is easing off the gas on reducing its balance sheet, we're likely to see less upward pressure in mortgage rates. Now, in my opinion, we've probably seen the last of 7%, 8% mortgage interest rates and rate hikes for the foreseeable future. And because the Fed is slowing down the pace of Treasury reductions, this is going to help stabilize the yields on long-term bonds like the 10-year Treasury bond, which influences long-term interest rates like 30-year fixed mortgages. But also, the Fed announced that it's not going to accelerate reducing their mortgage-backed security purchases. And this is extremely important, especially when it comes to mortgage interest rates, because this is an indirect way of them keeping mortgage rates low. So this MBS cap holds steady, there's going to be more liquidity in the mortgage market, which is going to keep interest rates in check. And well, what does this all mean for you as a borrower is that if you are in the market to buy a home this year or refinance your existing mortgage, then this might be a pretty decent time to act, because it's no secret that interest rates have been coming down since the beginning of the year. And really, this decision could further push interest rates lower. And if you're looking to buy a home, well, rates are more stable now, which means that you can lock in at a lower interest rate before there are any future rate hikes, if any. And if you bought a home in the last 12 to 18 months when interest rates were higher, then this could be a pretty decent opportunity for you to explore refinancing. Either way, the best case scenario is that we could see mortgage interest rates hold steady at this point or even dip slightly in the upcoming months this year. And honestly, guys, there are some predictions that say that mortgage interest rate can come down to a neighborhood of about 5 to 6%. But the part that we don't really want to ignore is inflation, because if inflation doesn't cool down, then the Fed is going to be forced to pivoting once again by tightening their policy later, and then decide not to lower interest rates twice this year, which is going to drive interest rates back up. All right, guys, that is the recap of the March Fed meeting, and I'm going to be keeping a close eye on interest rates, and I'm going to be keeping you updated to let you know if anything changes. Drop a comment down below and let me know if you think mortgage rates are going to keep coming down this year, if you feel like this is a good move by the Fed, and any thoughts that you have. I appreciate you guys watching, and I will see you soon. Take care.